This chapter introduces a new source document called a memorandum or a memo. So what is it? Well, let's look at what it's not. First of all, basically 99% of the transactions of the business will be things we've already done. For example, we'll receive cash, and that could be because of a cash sale, receipts from accounts receivable, GST received, GST refunds, or capital contributions of cash, and so on. We could also pay money, that's cash paid. That's like we might pay for an asset or an expense, payments to accounts payable, GST paid and settlements, drawings of cash. So that's not a comprehensive list, but just some examples of things we might receive and pay money for. What else? We might make a credit sale, so we sell inventory on credit, or we might buy or make a credit purchase where we buy inventory on credit. And the other thing we've dealt with is a return of inventory, so either a sales return from customers to us or a purchase return from us to the supplier. So that's going to cover pretty much most of what we do. However, each of those has their own source document, so we kind of know all the documents except for one. So when we receive cash, we're going to give a receipt. That's probably business generated receipt. So it could be manual, could be computerized, FPOS receipt, ATM receipt, BPay receipt, but we can also cross-reference that with the bank statement. And when we pay cash, the source document could be a check part or FPOS, ATM receipts, could also be a BPay receipt, but again, we can check it with the bank statements. For a credit sale, the source document is a sales invoice, and for a credit purchase, it's a purchase invoice. And for returns of inventory, the source document is a credit note. So we know all this, and we know it's going to cover pretty much everything that we do. We just got to deal with some odds and ends. What about when these transactions happen? So, for example, the owner gives the business a vehicle. So we've dealt with the owner giving the business cash, but what about when they give the business a car? How does that work? What about a transaction was recorded for the wrong amount and needs to be fixed? There is a loss of inventory due to theft. Maybe the opposite. Maybe there's a gain of inventory. Or the owner makes drawings of inventory. Or what about if we donate inventory to another business for advertising purposes? So these are kind of transactions that don't fit into what we've done so far. And there's no current source document that we could use that we know of for any of these. So what we need to do is create a source document for this. And it's going to be called a memorandum or a memo. And what it is, it's an internal source document used to verify transactions that either don't involve another entity, so they're within the business itself, that's why we call it an internal source document, and or maybe only involve the business and the owner. And what we say is basically memos are used to record the other or the irregular transactions that happen for a business. So what does it look like? Well, everyone's going to be different. So we've got a couple of examples there. Every question's different, but it's got some sort of commonalities. The first one is it will always have a date. Secondly, it will always have a memo number. It needs to have a unique number so it can be identified and verified later on, just like any other source document. It will also have some details of what happened, and that might also include an amount. It might not, it should, but sometimes it might not, which might be part of the question. But it's going to give us a description of what happened. And lastly, it's going to have to be signed off by the owner because it's an internal transaction that doesn't involve another entity. The owner needs to approve it so we can see the owner's signature there. When will a memo be used? Well, we're going to deal with 7 situations throughout the course. So the first one is when there's a capital contribution of an asset that is not cash. So it could be a car, could be inventory, etc. Situation 2, drawings of assets other than cash. So for example, instead of the owner taking out money, they take home inventory or a laptop, something like that. Situation 3, establishing a double entry accounting system for an existing business. Situation 4, correcting errors. And that's what we're going to cover this chapter, is those first 4 situations. There are some others though that we will deal with in chapter 8 and 9 when we deal with inventory. And they will be when we donate inventory for advertising, or we have an inventory gain, inventory loss, or inventory write down. And lastly, we'll also deal with balance day adjustments and a lot of those, but that will wait until unit 4.